Is anybody surprised that a company that's headed by an absolute lizard person really hates humanity? Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of October 10th, 2021. Just a reminder, I am not a financial professional. All information in the video is for entertainment purposes only. This week was pretty solid in the stock market. We had the S&P, the Dow, and the Nasdaq all rising substantially throughout the week. The Russell finished up flat from where it started. All in all, everything was kind of positive. Also, my research video that I've been planning for the last 2 weeks ended up turning out to be a dead end, and I found some stuff in the SEC filings that made me not want to go through with the video, so I'm not going to be doing that. That being said, today I do have an options play for you, and it's been a couple weeks since I did have an options play in one of my earnings videos, but I do have one today. So if you're interested in the options play, you can go ahead and skip to the end of the video for that one. I do have all the timestamps below. Let's get started. The first news story today isn't really a news story. It was just a super cool infographic that I found on Reddit this week. This is the world's most valuable brands in 2021, and these brand values are determined by multiplying their financial value by their brand contribution percent to get the brand value. So please note that this is not analogous to market cap. If you're wondering why some of these figures don't match up with market cap, I really love the layout of this infographic, and I realize that it's going to be really hard for you guys to see it on the computer, so I will link the infographic below the video. But basically, the larger the size of the circle, the more impactful the brand value is. And for some of the larger brands, it's also some of the larger companies. So we have Amazon, Apple, Google, Microsoft right here in the middle, along with Visa, MasterCard, Facebook, Tencent. Instagram is listed on its own, even though Facebook owns them, because once again, this is brands. And also up here we have, I know you can't really see it very well, but Pampers, which is owned by Procter & Gamble. And funny thing, Procter & Gamble is not even on here, but Pampers is. So this is a really cool look at some of the brands, and it can kind of show you some of the bigger companies in countries around the world that you might not be very familiar with. If we take a look at the growth of the top 10 most valuable brands, Amazon, Apple, Google, Microsoft, Tencent, Facebook, Alibaba, Visa, McDonald's, MasterCard, they're all still experiencing very strong growth, with MasterCard and Visa being the lowest as the financial providers at 2 and 4%, but something like Apple is still growing at 74%. And also, if we look at the 10 fastest growing brands, there's a lot of international here. We have Tesla, which is US, but TikTok, Pinduoduo, Meituan, Motoi, I know I didn't say those right, are all Chinese. JD's Chinese. Uniqlo, I'm pretty sure, is Japanese. Insta is US, and Lululemon's US, and Chipotle's US. So we do have a pretty good mix of brands here internationally. I think this speaks to the growing middle class in China and the consumerist society in China, the fact that some of these brands are growing so quickly. That's part of the thesis on why some people are very interested in investing in China. You know, a stock like Alibaba that's been beaten down throughout the year, it rose suddenly $30 a share this week. We opened the week somewhere around $138 for Alibaba, closed the week around $166. It was about a $30 rise. So you can see why people are so interested in China if you set aside the regulations and all of those issues. And that's a really big ask to set those aside. But the middle class in China is growing, and they are ready and keen to spend money. And that's really helping a lot of these brands grow quickly. Next news story, highlights from the 60 Minutes interview with the Facebook whistleblower. Documents obtained by 60 Minutes from a congressional source show Facebook employees' response to the January 6th Capitol insurrection and details about the company's approach to inflammatory content. Data scientist Frances Haugen secretly copied tens of thousands of pages of Facebook's internal research while she worked for the company and gave them to the SEC and to Congress. The 37-year-old from Iowa claims the evidence shows the company is lying about making significant progress against hate and violence. Now, I'm not going to go through the entire interview, the entire article. It's 13 minutes long. You can find it on 60 Minutes last week, and it aired on Sunday night. What happened on Monday morning? Well, Facebook stock absolutely tanked. We'll take a look at the chart in a moment, but the tanking of the Facebook stock was, on one part, a direct result of this, and then there was some server problems this week also. This story really kind of illuminated the worst of what a lot of us feared, that Facebook and social media is focusing on divisiveness, because their new algorithm that they put into place in 2018 focuses on engagement, and it's easier to engage a topic that makes you angry. So Facebook is intentionally putting forth topics that are going to incite incite anger and rage in people on social media because they want the interaction, they want the likes, they want the comments, they want the reactions, that type of thing. They want that type of engagement with their platform. Frances Haugen here feels that that was morally incorrect and improper, and she was actually working in the civic oversight department of Facebook, so she got to see all of this data firsthand, and she perhaps has better information than anybody has presented on the company yet. Is anybody surprised that a company that's headed by an absolute lizard person really hates humanity? I, for one, am not. I have been saying for a really long time that social media is toxic, and I try to use it as infrequently as possible, says Walrus ironically while posting a video to a social media platform, but you guys get the idea. I don't really log into Facebook during the week. I don't really log into Twitter or Instagram very much. There's just a whole lot of toxicity that I don't need in my life. I try to use Twitter for research sometimes, but that's about it. If we take a look at the Facebook stock, we've actually been on a downtrend for a little while. We peaked at about 384, and this was at the beginning of September for Facebook, and we've been trending downward, and right now we're sitting at about 330, 329.90 after hours. But the big drop here came on Monday morning after this story broke. Friday we closed for Facebook at 343 a share. Monday we ended up opening at 335 a share. So this was a drop on the day of about 5%, which is a huge drop for a company with a market cap over $900 billion. Another quick SEC related story. This is from the Department of Justice, the justice.gov website. New Jersey-based trader admits to involvement in an options trading scheme. Mark Melnick has pleaded guilty to criminal information charging him with a conspiracy to commit wire and securities fraud arising from a years-long scheme to manipulate the prices of short-term call options in large publicly traded companies. Melnick is the second defendant to plead guilty for his participation in this scheme. Another one named Bart Ross already pled guilty to conspiracy to commit wire and securities fraud. Between October 2017 and January 2020, Melnick, Ross, and at least 3 other individuals conspired to execute a scheme in which they traded securities, primarily short-term call options, based on materially false rumors about those companies that they generated and disseminated. These materially false rumors were intended to drive up the prices of the securities, both the underlying stocks and the options. Because these guys were buying short-term call options, they're much more prone and more volatile to quick rises in price. So they would open up positions, buy their short-term call options in these companies, then they would disseminate false information about these companies using Trillion, Twitter, and Benzinga, and this would drive the price up, and then they would close out their positions. This guy that they're talking about, Melnick, ended up making about $374,000 from this over the 3-year period, which it seems like a lot, kind of, but then you think about the amount of fraud that was being committed, and I feel like he was actually probably playing this very conservatively and closing out the calls very soon after like a short gain. So is anybody surprised by this? Again, just like the Zuckerberg story, no. I feel like everybody knows this happens on social media. We have to be super aware of pump and dumps all over. On my channel, this is one reason why I don't cover OTC stocks, because the volume is just non-existent and it's way too prone for pump and dumps. And actually, I've been contacted by multiple OTC companies now to do videos on their stocks to help lift the stock price, and I refuse to do it morally, even though they're willing to pay me, because I don't want to drive the prices up and end up, you know, giving somebody a bag to hold for a long time. I think these type of actions are deplorable, and this hurts everybody. But really, I hope this is just a lesson that everybody should do their own research. You know, on my videos, guys, I always show the address bar for the information that I'm looking at, so anybody can double check the information that I'm sharing on my videos. Just look at the address bar, look at the website. You can find the information yourself. I try not to be shady, but the fact is there are shady people online, and it doesn't take much. All it takes is somebody with a Twitter following of 20,000 people to start something, or somebody with a StockTwits following of 10,000 people to start something. And really, they can drive up the market even on these larger name stocks. Next news story, Palantir won an $823 million US Army contract for data and analytics software, just as another lucrative federal contract hangs in the balance. Palantir won most of this $823 million contract, not all of it, but most of it. And the Gotham Analytics platform that Palantir runs is going to prepare the US for future military threats. The new contract comes as Palantir faces potentially losing a lucrative ICE government contract. Palantir might be losing a contract with ICE for providing a customized version of Gotham called Falcon, which is a surveillance system that's been used to organize workplace raids. Palantir has generated up to $111 million in sales since 2013 from its Falcon work with ICE. ICE wants to replace Falcon with a tool called Raven. Where do they come up with these names? So we're replacing a Falcon with a Raven. Is this what the government does all day? I don't understand. Raven has been used to process hundreds of thousands of immigration documents to find evidence of people who aren't authorized to work in the United States. If you follow those numbers there, they gained an $800+ million contract, and they might be losing one that's already gained them about $111 million. So this is a huge net positive for Palantir. And keep in mind, this is the second U.S. government contract Palantir's gotten this year with a valuation of over $800 million. They got another one back, I think it was the end of January or the end of February, somewhere around there. Palantir just keeps locking up all of this government money, and that's one reason why people are so high on this company, despite its reputation as a bit of a meme stock company, because government funding is an absolute. And once these government contracts are signed, they're not going to be canceled. It's not like, you know, breaking off a partnership with another private company. So a lot of people are very bullish on Palantir because it seems like every month they're turning over another $10+ million, $100+ million government contract. If we take a look at the Palantir stock chart, the day that this news was released, we actually had a pretty big movement on the day, but everything was tempered a little bit. Overall, the net move on the week, it's not great. I think we gained just a little bit on the week here, but Palantir is a slow mover, and part of that is because of its float. This company is sitting on a 1.62 billion share float, so it's going to take a lot to move the stock substantially for Palantir. Next news story, DoorDash, Uber Eats, Grubhub must disclose hidden fees, give delivery workers all tips under new California law. This really isn't a big news story, but you guys know that every single opportunity I get to shit on Uber, I will shit on Uber because I hate that predatory company. So here we go. California will soon give up tip protections to delivery workers and require more transparency from DoorDash and other food delivery apps under a bill signed under Gavin Newsom. Oh boy. Anyway, gig companies have profited during the pandemic by keeping consumers and restaurants in the dark about the true cost of their services. Now small restaurants and their customers will know what they're being charged up front and get to see exactly how much is actually benefiting the restaurant. Politics aside, even though I'm not a big fan of Newsom and some of the stuff that he's done, this is a good move, and I think more transparency is always better in businesses, and I think these apps should be disclosing their information. Now, some of them, including DoorDash, were saying that they already were being 100% transparent with the tips their drivers were receiving, but still, if there was any discrepancy here with like Uber Eats, which hasn't commented on this, then they are going to be upping the amount that they pay to their drivers. And it really feels like states like California are really cracking down hard on Uber with some of the stuff they're able to do. I know this is Uber Eats, but you know, same parent company. I'm feeling some serious schadenfreude here. Happy for the drivers though, happy for the restaurants, and I hope this leads to them getting a bigger cut of the money that they're paying for these services. And I've heard that companies like DoorDash are charging an exorbitant amount of money to restaurants to list their products to use the DoorDash services. And it's to the point where almost the restaurants are not making much money at all. The margin's incredibly thin for the DoorDash services. But at the same time, what do you do if you're a restaurant? You know, DoorDash and Uber Eats, this is now an expectation for most people. So if you're a small restaurant and you don't put your food up there on DoorDash and Uber Eats, then you completely lose the sales altogether to your competitors. So it's almost like a situation where they're being forced into using these apps. Target is going to be paying employees an extra $2 an hour for peak days of the holiday season. This is going to be including Saturdays and Sundays in the final weeks before Christmas. The big box retailer previously said it would scale back holiday hiring and give more hours to its staff. The retail is offering higher pay as many retailers struggle to fill jobs and focus on retaining employees ahead of the peak shopping season. Target's minimum wage is already $15 an hour, and the company is sweetening the deal and offering even higher pay for holiday workers as many retailers struggle to fill jobs and focus on retaining employees. Korn Ferry, which is a talent consulting firm, polled 176 US retailers in September to see if the companies were having trouble hiring, and only 2% responded that this was not an issue. The big story here isn't the fact that Target is going to be paying its employees another $2 an hour. You actually have to zoom out here, and you have to realize that this is just a continuation of the trend that we've been seeing with US companies having difficulties in hiring employees. There's a lot of reasons for this, and a lot of this goes into social issues, financial issues, but the crux of the problem here is that these employers are being forced to raise their pay to bring employees back to the workplace. And from a humanistic perspective, this is good because employees are going to be getting more money, and everybody knows that minimum wage has not been keeping pace with inflation. It's still not going to be keeping pace with inflation, even if the companies are increasing their wages, but at least this is a small start. Now, I was shocked though with that Korn Ferry statistic after polling those 176 companies and revealing that only 2% of them them were having no difficulties hiring individuals, hiring employees. This is systemic. There's a real problem bringing employees in, and we're seeing this everywhere. And this is actually going to be one of the themes of the options trade that I'm going to be talking about this week. Tesla sold 241,300 cars in the third quarter, while other automakers saw big drops. Its third quarter sales were higher than expected. Tesla's bucked the wider trend of declining sales brought on by the global chip shortage in the third quarter this year, as it sold 241,300 cars, a total of 102,000 more vehicles from the same quarter last year. For perspective, the company sold 367,500 in all of 2019, so just in a quarter, we're already at 2/3 of the 2019 figure. One of Tesla's competitors, GM, the largest automaker in the US, said Friday morning that it only sold 446,997 vehicles in the quarter, which was a 33% drop from the same period last year. Tesla has avoided similar problems in part because it has been sourcing different semiconductors and rewriting software on the fly to make those chips work in place of the ones not currently available. Even more production is set to come online in the coming months too, as Tesla has built an enormous part of its factory in Austin, Texas, and is finally making it through some of the last approvals to start operating its new plant outside of Berlin. That's despite delaying some of its products like the Cybertruck and the second generation Roadster. Not only has Tesla built the new factory in Austin, Texas, but also the company just this week announced moving of their headquarters from California to Texas officially. So Tesla's leaving California behind, leaving behind Newsom and his corporate taxes, moving to a much tax-friendlier state, which is going to help with the growth of the company at this point. What Tesla's been doing with the semiconductors, though, is nothing short of amazing. Other automakers have been forced to completely stop vehicle production because they're not flexible enough to work with new semiconductors and work with the reprogramming required to adapt new types of semiconductors. Tesla, on the other hand, has been doing this from the beginning, and they've been very flexible with their supply chain. So whereas other companies are just showing inflexibility, and it really kind of brings the whole fossil fuel dinosaur of the automotive industry analogy into picture, Tesla's been very nimble in its rotation here, and its vehicle sales are soaring, and this is wonderful. A lot of this is vindicating the Tesla bulls and their support for the company for a really long time, Kathy Wood of ARC included, and I really hope that some of the legacy automakers can learn from Tesla's flexibility here and ability to pivot in situations where there are supply chain issues. If we take a look at Tesla's stock after that news this week, we did have a really big rise on Monday up to $806.97, and since then we've come back below 800 to 785.49, but overall pretty flat week for Tesla despite this awesome news. Now, my next story is a short report, and I want to preface this by saying I don't think short reports are evil inherently. I think people that short companies and companies that short companies are providing a valuable service for the market by releasing contrarian research for people to consider, and I feel like this really keeps companies honest. Now, I know that there's a knee-jerk reaction in investing. When you hear short, people are like, oh no, how can you bet against success? How can you bet against prosperity? That type of thing. But there are really bad actors in the market who are actually just trying to use companies to rip people off and to scam people. And this is where I think shorts play a very valuable service. To be clear, I'm not talking about something like naked shorting. I think naked shorting is a horrible, horrible thing that should never be done. But when you consider a company that opens a short position in another company and then releases detailed research about it, what is any different about the company doing that than it is for another company that has a long position opened up and then releases positive information or a positive news story? I don't actually see a difference between those two. A research firm can be long a company, they can be short a company, they can release their research and it moves the stock price. And either way, somebody's going to be benefiting from this. And morally, I don't see a problem with this either way, as long as it's not naked shorting again. So this week, Scorpion Capital released an investigative report on Ginkgo Bioworks, which is traded on the NYSE. The ticker is DNA. This was a recent SPAC merger. Their title is incredibly sensationalist, and I don't like the way that they format their reports. I've talked about Scorpion Capital here on this channel before. I think it was with their QuantumScape report, but the title is "A Snake Oil Salesman and Some Hedge Funds Partner Up to Pimp the Latest Synthetic Biology Scam as Phantom Revenue, a hocus-pocus business model, rampant related party games, and a decade of colossal failure get shoveled into yet another garbage SPAC. Damn, tell us how you really feel." The title's very sensationalist, and it's meant to be eye-catching, and this company is obviously trying to make money by shorting this, so by giving a sensationalist title, they're bringing in as many readers as possible possible, myself included. Now, before we get into the short report, really quickly, what is Ginkgo Bioworks? Because some people might not know. They call themselves the organism company. We can read and write DNA to program cells like we program computers. Expertise in strain improvement, enzyme discovery, new product development, biosecurity, and mammalian cell engineering. And I'll leave you with this lovely picture of gel and bacteria. Delicious. The short report from Scorpion Capital, it's on the front page of their website. You can see this. It's 175 pages long, 175 pages long. I think the crux of it is just in the first couple of sections of the article. Our research leads us to conclude that Ginkgo is a house of cards, in our opinion, one of the most brazen frauds of the last 20 years. Bold claims. The majority of its foundry revenue, an absurd 72% in 2020, and essentially 100% of its deferred revenue, are derived from related party customers. It created, funded, controls, or influences via the ownership position and board seats. Investments into these entities by Ginkgo and its largest investors are recycled back to Ginkgo and recorded as deferred or current revenue. Herein lies the problem, and in this report, Scorpion Capital reveals actual evidence of this happening. Companies sign up to work with Ginkgo. Ginkgo invests into these companies, and these companies recycle that money back into Ginkgo, and Ginkgo lists it as revenue. Also, they're listing it as deferred revenue, as future revenue, and this helped drive the valuation for its SPAC merger, and that valuation is one of the reasons why everybody was so excited about Ginkgo. How could this company have revenue that's this high? This is wonderful. And a lot of people thought this was one of these surefire SPACs on the market. But now, with this information that's coming out, and a lot of it was leaked by insiders of Ginkgo, everything kind of looks very doubtful, very dubious, and let's just look at a couple more slides so you can kind of see the idea. At a $23 billion market cap, it's rare to see related party racket on Ginkgo's scale in US markets. It's the US version of a China hustle when Chinese frauds, generally of the related party genre, listed in the US decades ago. We invested each of Ginkgo's related party customers, and as a preview of what a hardcore China hustle type scam it is, we note Kalo Ingredients, which has no employees listed on LinkedIn, yet Ginkgo booked an $11.9 million deferred revenue balance as of March 31st, 2021. We find this particularly brazen as Kalo was only formed 2 weeks earlier as an entity, according to its corporate registry filing, which further indicates that the entity's principal offices are Ginkgo's headquarters and its 3 managers are Ginkgo's CEO and 2 Ginkgo cronies. Kalo's site is a front and it appears to be hosted by Ginkgo. This is just one of the many companies that they provide as examples in this short report, but you get the idea. A company is magically formed, Ginkgo invests money into them, and this company pledges that money back or gives it back as revenue, and then Ginkgo can record the revenue on their books. This is just a shell game. This is a scam. Move the money. Where is it now? Oh, it's back with us. And I can see why this short report gained a lot of traction. Now, you would expect after such a damning short report that the CEO would come out and be able to refute everything if it wasn't true. The CEO for Ginkgo came out, and let's read his statement. Our focus at Ginkgo is increasing the scale of our platform so we can deliver more cell programs to customers. We were doing that yesterday, we're doing it today, and we'll be doing it tomorrow. One thing the report today criticizes is that new startups are launching programs on Ginkgo's platform and leveraging Ginkgo to secure capital, get resources, and launch their company quickly. We don't think that's a problem. Starting a biotech company should be as easy as launching a website. We're happy we make it easy for companies to start on Ginkgo's platform, and hopefully more entrepreneurs hear about our platform today. That's not really a statement. He just echoed the company's purpose and said they're going to keep doing what they've been doing, and this is the natural flow of their business model. Huh. That's an interesting defense. Sorry, teacher, no, I didn't submit my homework late. You see, I always submit my homework late. So when I submit my homework late, I'm actually submitting it on time. That's the kind of logic they're employing here, where they've always been doing this, so it's okay. Oh boy, guys, I don't know how I feel about this one, but it's not good. Take a look at Ginkgo's chart, and they got absolutely wrecked this week. We had climbed up after the SPAC merger, after everything went public, up to 1425, and on Monday, we ended up opening at 1160. 1165, and you could see the volume spike when the short report was released. And on this day, we had a high of 1175 and a low of 913. Currently, we're trading at 1033, 1039 after hours. All in all, this week, we've had almost a 20% decline in Ginkgo's share price. All of it can really be attributed directly to this short report. However you feel about this, take a moment, read the entire report, and make an opinion for yourself. Don't just take my word. I'll go ahead and post a link up here to the article, and you can check it out for yourself. Next news stories, there's some macroeconomic stuff. I know it's really boring for a lot of you, so I'm just going to hit these very quickly. September's jobs creation comes up short with a gain of just 194,000. Non-farm payrolls increased by 194,000 in September compared with the estimate of 500,000. That's not even remotely close. The unemployment rate did drop to 4.8%, which is better than the expected 5.1%. I don't really understand how these two numbers work out so differently with the rate dropping, but the jobs not going up as high as expected. I guess there was just vacant jobs that were sitting in the market that got filled. The US economy created jobs at a much slower than the expected pace in September, which is a pessimistic sign about the state of the economy, though the total was held back substantially by a sharp drop in government employment. Not much to say here. The market didn't actually react very negatively to this. Friday was overall a pretty flat day, so even though this was just released on Friday, the market didn't much care. This is just the trend that we've been seeing going back to the previous month where the jobs numbers are falling off below expectations. So I'm assuming by next month, the forecasters are going to be a little more close to accurate after they've seen the last couple months of performance with these jobs. Next news story, I'm literally just going to read the headline. The Senate approves bill to raise the debt ceiling and avert default for now. We talked about this last week. The US debt ceiling was getting surpassed. We had to raise the debt ceiling, otherwise we were going to default on our repayments for the first time in the history of the United States. Was that going to happen? No, of course it wasn't. Every time we've breached the debt ceiling, we've raised it again. This whole thing was just bullshit political theater so politicians could feel valuable and important and feel like they control the fate of the world in their hands. I hate politicians so very much. Let's take a look at the upcoming earnings for the week. Again, I am recording on a Saturday. I'm going to be traveling after the video today, so I don't have the really spiffy earnings whisperer calendar graphic, so we're just gonna have to go through the NASDAQ website. Monday, nothing. Tuesday, also nothing really. I guess Century Bancorp's kind of interesting. Fastenal Company, I didn't realize their market cap was so high. Wednesday starts the banks though, and this is where it starts to get interesting with JP Morgan Chase, Goldman Sachs, BlackRock, First Republic, and specifically when I look at these bank stocks reporting on Wednesday and Thursday with Morgan Stanley, Citi, US Bancorp, I'm going to be looking at any fallout or anything with the Evergrande situation. I'm going to see if they're going to be talking about reallocating their funds or any negative residual effects from those things, especially from a company like BlackRock. So I'm going to be reading through all of the bank reports. I always read through bank earnings reports anyway. I think they're very interesting. Friday is one that actually inspired me to do an options play. So we have a couple of trucking companies reporting on Friday. We have JB Hunt, which is a huge, massive trucking company with $100 billion market cap. And we also have this tinier one down here, Heartland Express, which only has a $1 billion market cap, but it's still a countrywide trucking company nonetheless. Now, let me preface this by saying what caught my eye about this was the market cap for Heartland. And I was thinking about the increased oil prices, how oil prices right now are really high, and this affects fuel for trucking companies. But the way that trucking companies do their billing, they usually pass off fuel increases as surcharges to the customers, and they make the customers foot the majority of the bill. We're entering the holiday season now, so this is the big retail expenditure thing. We've had container shipping issues, and shipping container prices are way up right now, and a lot of ships are backed up, that type of thing. There's actually been a truck driver shortage to get all of this stuff delivered. I've been reading about this for a couple of months, and the truck driver shortage is part of it related to the wages that the drivers are getting paid. Part of it is just there's too much inventory and not enough trucks to meet the demand. Every company has been dealing with this, and Heartland is no exception. So I wanted to look into Heartland a little more to see if there was an opportunity here, and I actually think there is. So Heartland is experiencing a driver shortage, and this was mentioned in some of the company's PR and releases. Now, this is their last earnings report. They had a net income of $20.7 million, basic earnings per share of 0.26. Their stockholders' equity was $741.8 million, which is a record high. They have a debt-free balance sheet, and they have a cash balance of $167.2 million and total assets of $957.0 million. When you look at this from the last earnings report, holy crap, this is a financially healthy company. The stock price must be really high. It must have a really high PE ratio. There must be something here leading to believe that it's overvalued, but actually it's quite the opposite, as we'll see in a moment. On the last earnings report, they talked about how they might be looking for an acquisition of another company because they have so much cash on hand, and this would help add some drivers to their fleet if they do acquire another company. Also, they talked about lowering the average age of the tractors in their fleet from 2.1 years to 1.8 years over the last year period, and they talked about expanding with some new contracts. So all in all, it was a great earnings report. They were sitting on all this cash and they wanted to return some equity to shareholders, so they released a special dividend to all shareholders that were holding by September 1st close of business. They got paid out a 50-cent dividend per share by October 1st, which happened just last week, and that ended up leading to a little bit of a decline in the stock price because the dividend was paid out. Also, they've been doing a share buyback program. Insider ownership of Heartland is very, very high. We've actually seen over the last year nothing but buys for the last year. We have to go back to August of 2020 to see the last sale. So we've had nothing but buys coming in, and the current share price is below the level of these buys. Institutions, it's a mixed bag. We do have some new positions opening up, some old positions closing out, so that's not really anything definitive. But here's the really interesting thing. This is a press release from August 20th. They announced the 50-cent per share dividend, and they announced the authorization for the repurchase of up to 3 million shares of outstanding stock, adding it to the approximately 3.7 million shares remaining. This brings it up to 6.7 million shares that they can buy back, and we don't know how many of that they've done, and we won't know until Friday. The shares outstanding for the company is about 80 million, and they can buy back about 6.7 million. So we're looking here at a repurchase of about 8% of the shares outstanding, which is really, really high. The price to sales, price to book ratio, they're pretty low here at 2.04, 1.73. The PE looks a little bit high at 17.81, but when we compare that PE ratio to other trucking companies in America, we've got 15.8, 16.3. This one's really low at 4.5, 34.75, 117, 16.7, 34, 293. Suddenly, you know, this ratio of 15.7 doesn't really look so bad. Hunt, this is another big company with a ratio of 28.8. Theirs is higher. The IV right now is pretty high at 31.6. The historical is 15.3, but in the last year, we've only gotten as low as 18. So this is slightly less of a deviation than it is to the historical average. There's 7 analysts covering the company right now, 4 holds, 2 strong buys, 1 strong sell. And if we take a look at the chart for Heartland, it looks really bad. I mean, we're in a downtrend. On the COVID drop, we ended up hitting a low of 15.65, and right now we're currently sitting at 16.08. RSI is downtrending, MACD is pretty low. So nothing here looks great. So why do I even care? Net income is actually increasing. They're becoming a little more efficient in running their business. So why do I think this is actually an attractive play? Because of that share buyback figure. Now that share buyback figure is not going to be executed all at once. We'll find out on the Friday earnings report how many they actually bought back, but I bet they have not bought back the full 6.7 million shares that they could. That 6.7 million shares is about 8% of the float, which translates to about an 8% increase in share price. So that 8% increase in share price is kind of what we're actually looking at here, is the upside on top of natural growth coming out of the retail shopping and spending season, which is obviously going to be very good for trucking. With fuel prices going high, surcharges are being passed on to the customers, so that's not a huge factor for the company. If we take a look at the options ladder right now, you can go all the way out to March 18th, 2022 on this one, and you could buy some of these 1450 calls for $220. If you go ahead and add those up, $220 plus 1450, we're looking at a break even of about 1670 right here. The current share price is 1608, and we know that there's more buybacks coming, and we know that we're getting through the holiday season. So you're basically betting that the share price is going to be rising 62 cents, and you're paying $220 for that over the next 5 months. To me, that's actually a very attractive bet to take, because that 62-cent rise off the current share price to the break-even price of the option is much less than would be generated from an 8% buyback of the shares outstanding. So this looks like a pretty solid opportunity for me, and I'm going to open up a couple of these 1450 calls for March 18th, 2022. I'm not going to get greedy with these. I'm going to sell them pretty quickly, and realistically, this is money that I can afford to lose, but we're close to the floor that the company hit on the COVID drop. The company's in better financial shape today than it was at that time, and the company has a newer fleet than it did at that time, which means lower operating expenses. That's all for me today. I hope you guys did enjoy the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Check out Webull. They have new promotions almost every single week. Also, if you enjoyed the video today, please like the video, subscribe to the channel. If you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. lot, stay safe, good luck investing, and I'll see you next time.